Are you good at managing your money? What if you suddenly found out you're missing a lot of money? Not just a little change, but billions of dollars disappearing mysteriously? Today we're talking about a big accounting scandal called the WorldCom fraud of 2002. They messed up their financial records, hiding billions of dollars. Let's find out how they did it and what happened when they got caught. Join me as we explore this scandal. Let's dive in. WorldCom was a big telecommunications company in the US. It started with Bernard Ebbers and some others coming up with the idea in a coffee shop. They created a company called Long Distance Discount Services Inc. It became really successful and grew to be the second largest long-distance telephone company in the country right after AT&T. Ebbers was appointed Chief Executive Officer of the business in 1985. It was able to purchase more than 60 distinct telecom companies 10 years later in 1995, at which point it changed its name to WorldCom. Its quick expansion contributed to solidifying its standing as one of the top telecom firms in the US. In that period, it made its first significant purchase in 1992 when it paid $720 million to acquire Advanced Telecommunications Corporation. It even outbid its larger rivals Sprint Corporation and AT&T, giving it an advantage in the telecom sector. At $175 billion, the corporation was valued at the peak of the dot-com bubble. Following a $37 billion merger in 1997, WorldCom and MCI Communications became MCI WorldCom. Now, you may be thinking, this seems like a really interesting story. These days, investors are cautioned against making investments that appear too good to be true by using the WorldCom narrative. How could they have fallen so hard so fast? What caused them to die? Let us examine the methods used to unearth the issue in more detail. Before moving any further, subscribe to my channel and hit the notification bell if you want to learn more about schemes like these. All things financial, business education, becoming business savvy, and watching more videos like these. I hope this brings you many sweet returns. The WorldCom fraud is closely tied to the dot-com bubble, or the time that the stock equity valuations of the United States rose at a rapid rate. When the dot-com wave rolled in during the late 1990s, many people decided to invest in the tech market. However, it was one of the cases where the investment turned out too good to be true and it turned into a bubble. When the bubble burst between 2001 and 2002, many businesses and individuals were negatively affected, with some even going bankrupt. The bursting of the bubble wiped out trillions of dollars worth of assets, and WorldCom was not safe from its repercussions. Is the phrase cooking the books familiar to you? It occurs when accounting tactics are used to doctor or modify finances or accountancy reports, making them appear better than they actually are. It's precisely what WorldCom carried out. By falsifying important financial data, the corporation sought to artificially exaggerate the earnings that were reported on their profit and loss statement. And what do you know? The management knew about it. They even coordinated the entire incident, in fact. The chief financial officer of WorldCom utilized billions of dollars in operational costs, allocating them across property accounts and designating them as capital expense accounts. WorldCom was able to demonstrate to its investors that they were cutting back on expenditure as the years went by doing this. Investors were unaware that this was untrue, of course. WorldCom was able to fabricate $3 billion worth of income, and they chose to declare a $1.4 billion profit rather than a loss. Had they been honest and not falsified their balances, the reports would have indicated that WorldCom had a loss for both the first quarter of 2002 and the fiscal year 2001. What then transpired? How did they come to be found? Well, a number of things led to that. A finance analyst named Kim Mig was instructed in December 2000 to classify labor for capital projects in WorldCom's network system divisions as a cost rather than a capital project. Mig conducted more research and discovered that this would have an impact on capital spending of almost $35 million. Mig believed that he was being forced to conduct fraud as a result, namely tax fraud. After bringing it up with his superiors, the order was revoked. Still, Mig received a reprimand and was let go shortly after. During a 2002 interview with Fort Worth Weekly, Mig said that he had been worried for years about the company's spending practices. He argued that WorldCom was able to restrain MCI's expenditures at the time of the merger since he had come from the MCI side of the 1997 merger. That didn't stop him, though, from receiving massive vendor billing invoices. Glenn Smith, internal audit manager at WorldCom, read the subsequent piece. He reported this to Cynthia Cooper, the vice president of the firm, and they decided to do some internal audits, which they began in May of that year. They discovered something disastrous. CEO Bernard Ebbers was compelled to resign in April. By June 2002, WorldCom had admitted all. After the corporation disclosed fraud of about $4 billion, WorldCom filed for bankruptcy on July 22, 2002. The corporation filed for bankruptcy in the largest bankruptcy filing in U.S. history to this day. Following the company's bankruptcy filing, authorities scrutinized Ebbers and CFO Scott Sullivan in particular among the company's senior executives. It transpired that Ebbers had utilized his firm shares as security to borrow around $400 million from Bank of America for margin calls. He was found guilty of securities fraud in 2005 and given a 25-year jail term. Due to poor health, he passed away in February of 2020. Although WorldCom was later acquired by Verizon, its history should serve as a warning to both telecom firms and investors. Among the most notorious corporate accounting scandals in history is the WorldCom affair. Executives at the massive telecom corporation used dishonest accounting techniques to exaggerate the company's profitability and conceal its growing indebtedness in the early 2000s. Due to the incident, WorldCom had to file for bankruptcy, which lost investors billions of dollars and resulted in the prosecution of several senior officials. Strong internal controls and corporate governance procedures should be put in place by businesses to ensure that crises of this nature don't occur again. The following important regulations may be able to lessen the likelihood of financial fraud. Ethical leadership. Ethics and honesty should form the pillars of organizational culture, starting from the top leadership. Leaders and board of officers must be the role model of ethical behavior and accountability by filtering it on organizational level so that everyone will behave equally. Financial oversight. Set up a separate audit panel that should be chaired by independent qualified people that can be sure in executive financial reporting and internal controls. Reputable accounting firms need to be involved during audits on a regular basis in order to monitor the standards and regulations which are issued. Internal controls. Establish strict internal control and anti-fraud measures to avoid and detect any kind of fraud. Apart from this, ensuring separation of duties with the inclusion of occasional reconciliation and detailed review of financial transactions also forms part of the existing framework. Whistleblower protection. Cultivate employees' awareness of ethical standards by offering an anonymous avenue for reporting any unethical actions that may have encountered without any retaliatory measures being applied to them. Exposure of fraud programs by whistleblower protection policies can reveal the fraudulent matter and slow down its expansion. Regulatory compliance. Stay on course with the most recent laws and ordinances related to financial reporting and governance in the corporate world. Compliance with regulatory norms validates the legality, thereby ensuring that the individual has completed every transaction ambuscally, and no information could be hidden in the financial statements. Risk management. Do frequent risk assessment of all weak spots in order to identify possible threats in terms of fraud and corruption. Introduce steps to compensate for these risks and monitor them accordingly. Remember, the direct instruction in the current version flows out clumsily and struggles to deliver the intended message adequately. Policies and strategies as stated in this paper can considerably strengthen companies' governance structures, and financial corruption such as the WorldCom bankruptcy can be eroded. Noting this, the consistent monitoring of the ethical practices and developing and cultivating an ethics culture in the company are key to the trust and authenticity in a corporation. Stay tuned, stay educated.